Just a few seconds to go here. See what CPI has for us today. All right, CPI is out. We have an initial reaction higher on risk assets. I mean, wow, dollar index really shooting lower. S&P up to 59. NAS, what are we looking at, guys? What are we looking at? Low CPI, it's got to be low. 2.7. I mean, that was a violent move. What is that on indices? 1% up on the NAS and S&P right off the rip. That's got to be at 2.7. That's my guess. Oh, it's 2.9. There's got to be something there. Core, what was core, guys? What was core year over year? If it's 2.9 and it had that reaction, 2.9, but core was light. Yep, so core CPI was a little bit low. Lower than forecast on core. Wow, look at that reaction, guys. There we go. We've got S&P, NAS ripping here. Russell's up. We'd love to see it. That's what we needed in terms of a price reaction. But the 2.9 read, you have to just think, the market was so fearful that inflation was going to, sorry, I'm not sure why we're not loading CPI properly. You got to think the market was so scared of like a 3 or a 3.1 handle coming in. And instead, inflation this week was relatively less threatening than what people were fearful of. People were saying, oh my gosh, PPI is going to drift higher. Look, I mean, if going into this week, it would have been a reasonable thought to say, look, we've had 3 back-to-back higher than expected producer price index numbers, should carry over into a hot CPI, hot PPI this week. And we've got something opposite. So we're staying at 2.7, flattening. I'm sorry, we're staying at 2.9 relative to forecasts of 2.9. So that might be a little confusing. Yes, inflation went higher, but it didn't go higher than we thought it would. Forecasts were like, okay, we're going to probably get a 2.9, and people were buckling up for a 3, if that makes sense. But the other thing that you want to look at is, okay, CPI wasn't too threatening, but core was good news. Core CPI is removing some of the more volatile components of inflation. You remove the core, or you just look at core, that coming in low is something good to the markets. That could suggest that like core PCE numbers could come out also healthy. And what this tells you guys is, look, you've got a rip here in risk assets because this market is saying we are growing really strong. Look at the US economy, right? I want to show you something, guys. I'm going to show you guys behind the scenes on the Edge Finder because I was working on something this morning. I'm working on a US economic data page. I'm actually so excited for this page. It's really simple, but we're just going to look at economic data and have the forecast and actual, all of it in one place. So pumped to have this in front of me. It's not done yet. We're going to add more layers to it. In fact, I just put my team on this project today. So we're going to be adding some new features to this new page. It's not yet available. So if you're an Edge Finder user, you won't be able to see this yet, but it will be soon. This is going to be all US economic data in one place. But look at this. It's all blue, right? US economic data is killing it. So if you have a scenario, let me ask you what you think about this. You tell me how you think stocks should perform if the economy and hiring is ripping and inflation is just kind of not going too far. It should rip, right? That's the idea. I think that's what we're looking at. You're saying, oh yeah, inflation did tick higher a little bit in the last few months, but it didn't exceed our fears. And at the same time, retail sales better than expected. Services and manufacturing PMI numbers better than expected. GDP growth way better than expected. Unemployment rate ticked lower. NFP was strong. Hiring is strong. Outlook on the economy according to services and manufacturing, key players who report on the PMI numbers. Their forecasts are optimistic. There's also probably a little bit of optimism around Donald Trump coming back due to the continuation of low corporate taxes and less regulation in the banking, the mergers and acquisitions part of the economy. I mean, in my view, I continue to say risk assets look attractive. And especially now today, I'm not too worried about a 2.9 inflation if you tell me the economy is ripping, right? So you get the economy ripping and inflation chilling. I will take that all day long, right? Plus, you've got some animal spirits around Trump, whether you like him or not, doesn't matter. He's a stock market guy. People in the stock market like Trump. You can see that in the reaction to the daily candle if you go look at the day he was selected to be the president. Granted, same thing with Biden. People just kind of buy the market when the presidential election is past us, usually because there's no more fear around who won the election, and the market can kind of move on with its life. But I mean, we see this pretty consistent pattern here of an economy that wants to go and a Fed. Like, here's my opinion on it. You might say, but no rate cuts. Like, if we have a really strong economy, my response to that genuinely is, so what? Give me one rate cut this year, and in a rock solid economy where companies are going to grow like crazy, I'm taking that way more than the labor market cooling off and we get 3 rate cuts this year. I'd rather have one rate cut in a super solid economy than the former, right? That's my opinion on it, and that's where I continue to be. That is part of the reason why I currently have a long position on Bitcoin. You might say, what the heck does Bitcoin have to do with that? And the answer is everything. Bitcoin is a risk asset. It does well typically when the NASDAQ does well. It does poorly typically when the NASDAQ does poorly, but it's sort of a way to capture some extra volatility without paying for a bunch of leverage. So I have a long speculative position on Bitcoin with a stop loss below. In fact, after stream, I'm going to tighten up my stop loss a little bit. I'm not going to trail it into profit just yet, but I need to go ahead and adjust my stop loss probably just below this swing low. But Bitcoin, this signal inside of the group went crazy. I am still in the move. I'm going to go ahead and let me just pull up where we're at with this. Give me 1 second. So Forex side of things, Bitcoin, I don't really know where to put this. I guess I could create a crypto tab in my next trade signals section, but I just put it in Forex for now because it's kind of a currency, right? I guess. So anyways, I bought Bitcoin. That was 2 days ago. This thing is ripping right now, and my goal is to continue to hold this one. What I'd look for in Bitcoin from a price action perspective, that was a bad drawing. What I'm looking for in Bitcoin is a break above, back into the 100s. You get a closure above this area, I'm going to look to trail my stop loss into profit. So that's how I'm going to be managing this position. That's what I'm looking to do on my Bitcoin signal for those of you guys who are in our VIP room.
Trading is hard, but trading by yourself is even harder. This year is your year to join a trading community. The A1 Trading VIP Discord community is made up of thousands of traders around the world committed to helping you learn and to find better trade setups. Inside of the Discord, you can browse Trader Nick, Frank, and Ivan's trades on all things Forex, stocks, options, and ETFs. You also get exclusive access to Ivan's live coaching webinars, where you can learn from a seasoned professional in the industry and even ask questions during the webinar. We also have chat rooms filled with traders who share their thoughts and analysis daily. It's a space for both veteran and new traders alike to come together over their love of markets. Want to take it a step further? Upgrade to Pulver Alerts, where veteran money manager Chris Pulver shares his daily options and stock positions. All things A1 trading are happening in the VIP Discord. Start your new year off on the right foot and join today.
On what's going on with the pound. Why has there been so much talk about it? Why is it being so weak? Why is it suddenly gaining strength? Because it's important to understand these things. So if we start and we just look at what is the basics of the UK economy. Now, this is probably going to be a little bit boring for some of you, but if you just listen, you will learn something and it will benefit your trading. So just bear with me, okay? So if we look at the UK, imports and exports, we all know that this is a big factor of any economy. How much are they bringing in? How much are they exporting? So we can see the first thing here is exports. So this is what is the UK sending out, services and goods. We've got 849 billion. However, that might sound good, but it's not when we look at it relative to UK imports. So if we look at the imports, it's 881 billion. So they're importing more than they are exporting. Now, this is obviously a bad sign. So if you're a company, or a country in this case, and you're buying more than you're selling, you are going to be losing money. So what does this tell us? How is the UK not bankrupt? Well, the UK is relying heavily at the moment on foreign investment. That's why the UK is bolstered, basically. That's why the pound isn't completely on the floor. However, obviously, market participants really don't like the current situation in the UK, pushing up the gilts. Now, gilts are what the UK pays on their debt. So at the moment, they're paying 4.728%. And we're currently, well, not currently, but today, we were currently at the highest gilt level we've had since the GFC, which was the great financial crash back in 2008. So this has been a big worry for the UK and for investors, basically saying, is the UK doomed? How much and can they afford to pay back the debts they owe? And the question was really not certain. Also, the answer was complete uncertainty, really. So this is what has been driving up driving down the pound due to problems. So why has it dropped? Well, the reason it's dropped is because we have had UK inflation today. So that came out this morning. And luckily, I'm saying luckily, not in terms of my trading specifically, I'm saying luckily for sort of investors and sentiment and things, inflation is slowing down. So that means it's likely, and it's currently getting priced in, that we are going to have some rate cuts by the Bank of England. That's now the new expectation. So that is helping these gilts start head to the downside. It's giving investors a little bit more confidence. And this actually is a really, really good example of when rate hikes and rate cuts don't follow the typical narrative of being bullish and bearish. Rate cuts are implemented due to different things. So in this case, a rate cut is actually really good for the pound because it's needed. So the UK economy basically doesn't just collapse. So that's the little class done. I hope that was beneficial to some of you. I know it wasn't a super in-depth thing, but that is an explanation on why the pound is in its current situation. We've also got some other factors. We've had really, really good dollar strength recently, causing capital flows into the dollar out of the pound as investors start allocating capital to stronger currencies. So there you go. Now we can get on to what you're actually here for, which is some chart analysis. Charles wants yen pairs. Sure, we can have a look at the yen. So I'm still on the fence with the yen, but what we do know is that Danske Research, which is an institution, currently have a sell limit at 160 on the dot. And what have I been saying for the past week, 2 weeks? Well, I've been saying 160 is the danger zone for the next intervention. And it seems like institutions are starting to pivot themselves around this 160 level. So this is still in view. This is still the point of danger, really. So I am conflicted because an intervention is still in view, in my opinion. The yen, it does need one, really. However, we are also now getting a rate hike this month. I think it's on the 24th of January. Is projected. The Bank of Japan is now projected to start hiking rates. So this is obviously beneficial for the yen. So it wouldn't, in my view, it wouldn't be out of the question for dollar yen to continue to head to the upside for the next sort of 10 days. Well, it'd be 9 days now until the Bank of Japan rate decision. Sort of towards 160 up to 165. This is sort of where I'm guessing we are going to have, or we're going to start possibly starting to reverse short term. And then during this point, we are again at intervention risk, and we are in the Bank of Japan. We're in the intervention risk and Bank of Japan intervention. Sorry, I'm getting my words mixed up here. Bank of Japan rate decision and intervention danger zone is what I'm trying to say. So I would expect slightly higher prices dollar yen, and then when we get to sort of 160 to 165, maybe start looking for short positions or to get out of long positions. Why is gold rallying up at times with DXY, yet it's priced against the dollar? Good question. It's quite a common a common question as well. So the gold isn't a currency. It's not counter the dollar, really. So when you're looking at gold and you're looking at the dollar, just because the dollar's up, it doesn't mean that gold has to be down. So if we look at Russia, Ukraine, for example, or the Middle East, whenever war breaks out, we can see the dollar and gold simultaneously gain in value, and we can also see them decreasing in value at the same time. So don't look at gold as a currency, because it's not. It's a precious metal. It moves typically a little bit differently to currencies. You entered gold buys. Good stuff. Yeah, I know a lot of people actually been buying gold recently. So the gold bulls at the minute are making some pretty good money. For me, we're still too stuck within this range, really. I mean, we're coming up to a triple top here. I mean, you know, it doesn't mean too much, but it's not somewhere I'd really like to be a buyer. So I'm sat on my hands on gold for now. Thank you very much for the class on the UK, James. Yeah, no problem. I mean, again, it was just a very short breakdown, but hopefully it shines some light for some of you on what the situation is. Serge, yes, I am still short on euro dollar. Scaled in again once we got CPI news. I'm still in on my euro pound positions as well, so I'll show you that one on TradingView here. So we are now seeing some downside coming back to my average price. We seem to have rejected this resistance on our 200 daily moving average quite nicely. So yeah, still sat in these. I'm still overall in some pretty nasty drawdown, but it's fine, really, in my opinion. I'm completely happy to hold. Euro dollar, I wouldn't expect it to suddenly start reversing to the upside, so I'm happy to continue basically just clicking sell on any pullback we see. So if you look on the daily, the trend is completely intact. So these short positions are completely fine with me. Thoughts on dollar Swiss? Good, dollar Swiss, good call. I'm in dollar Swiss as well. Looking to maybe scale in if we continue to see some drawdown here. I'm actually just going to change this to an area chart. But yeah, I think we're pretty set. The only real concern with dollar Swiss, in my view, is this daily, weekly resistance through here at sort of, what is it, 0.92. But as soon as we can break that, or if we break it, I think we're pretty much smooth sailing until I take profits at the next high. Again, we've seen some downside on the dollar today due to CPI. PPI was also weak, but generally, I'm still pretty confident to say the dollar is bullish. Bernard, hello, good to see you. Gold also likes a low interest rate environment. Did you finally decide to come settle in Africa? No, I don't think Africa will be my place of residence. I'll definitely come and visit Africa, but yeah, I don't think I'll be moving there. When would you stop shorting EU? That's a good question, Serge. I'll stop shorting EU when there is a change in economics. When I'm no longer super bearish on the euro, or I'm not bullish on the dollar, then I'll stop. But for now, again, PPI, CPI was a little bit cooler than I would have liked, but generally there's not that much to make me want to go against the dollar at the moment. So I'll probably be shorting until we get to, or towards parity at least, so a little bit closer to 1.0, which is down here. So in between these two levels, I'll probably start looking, maybe not to go long again. There's not really any factors for that, but I'll start just taking my foot off the gas a little bit and take it a little bit slower, because once we get to sort of parity, I am expecting some sort of influx in buyers. Nothing to change the trend necessarily, but something that will induce some buying and have a bit of a larger pullback. Obviously, parity is a pretty major level. It's a big psychological level, so more than likely we'll see some buying off that level.
Let's take a look at the heat map. Everything but green. We got 80% of stocks advancing today, led by everything. So market's all excited about some CPI data, which I thought was interesting that it's not all perfect, but here is the trade. Now, what I think is something to watch for, take a look at the SPX. Okay, technically speaking, this makes sense to me that, yes, we did have a really nice gap today and prices pushing up and everybody's all excited, right? 2% plus on the NASDAQ, 1.77 on the SPY, Dow's up 1.6, Russell's up, I think, over 2% right now. Russell's up 2 1/3. So I mean, we got green across the board. 80% of the stocks advancing. It's a nice little broad market rip. But I will say this: the bulls are making a nice little comeback trade today, but they are facing some resistance that is right ahead of them. So I could see this market having a little bit of momentum to the upside, maybe getting back to the 6,000 handle. And I would say, if you're taking notes here, write down 6,000, because if the SPX goes to 6,000 but gets rejected, then we come back and fill the gap, and there's all sorts of pressure that returns, right? And this is nothing more than a little bit of a pop to the upside as the market fades it back down, fills the gap, and then possibly hits some fresh lows with this 144 to 200 moving average that we've still been waiting to get hit. It's over 300 bars. It makes sense we'd have a little correction. I would much rather see a correction that is like an orderly correction like we're getting now, although traders kind of hate watching this happen because it feels like paint drying or a lot of volatility, right? But if this were to happen, I would much rather, build positions off of a nice bull pattern off the 200 moving average after it's been checked off, and then see if we can get back to the highs. That's not how the market's going to move, though. Like, it's going to do whatever it's going to do, right? So if we come up here to 6,000 and we break above 6,000, any type of pullback here, I would say, has more legs to the upside. My concern is that we poke the 6,000 and then we reject the 6,000. And if that happens, there's obviously a gap fill from today that could be filled right away, right? So let me go to a slightly higher time frame here in the 15-minute. This is a good look at the last couple of weeks of trading, and that would be my kind of channel look. All right, we did have the S&P did fill the election gap, the Dow filled the election gap, the Russell filled the election gap, and then some. So with this election gap offering some support, and obviously have the follow through today on S&P on the CPI news. I see we could have some follow through. We come to this area. If this is a rejection, then we're going to have a gap fill maybe in the next few days. Even if we come back to SPX at 60.50, 60.50 here, it looks better, right? It looks better than 6,000, but it's still the same holiday high that was showing some resistance right off the FOMC breakdown in the 18th. So just some technical stuff there. We'll see. Now let's get into the actual numbers, because like I said, I don't think that people are looking at this and saying everything's great. Here's what I see. Look at that. Here's the Fed Watch tool. Look at the probabilities. Nothing has changed on the Fed Watch tool. Okay, we're still at like a 97% chance that nothing's going to change. It's going to be a pause in January at the end of the month. We're going to have core PC at the end of the month as well. Probabilities here have not changed. The market is looking at maybe one rate cut for 2025, and it would be June. According to this probability right now with the Fed Watch tool, June would be our one rate cut, and that's it. So the Fed is mostly neutral. I wouldn't say hawkish necessarily, because they're not talking about raising rates, right? Fed is definitely not talking about raising rates, although they will say it's not off the table. They're not going to really give you anything to defend it. It's right. It's interesting. The Fed is so transparent, yet they're not. Like, they're so vague that they can say two things, like we will or we won't, or we can and we can't, or we might and we might not. But at the same time, they drip so much information with this tool that we look at every single week or every single day or whatever. But there's no major changes. So the market came into this year thinking maybe 1 to 2 cuts. It looks like pretty definitively right now, 1 cut. And that's not coming until June. So the first half this year, the Fed is pretty much doing nothing and just letting the data come in. If they need to do anything else as far as monetary policy, then it's subject to change. Would the Fed cut more aggressively? I think they'd be stupid to cut more aggressively. I really do. Like, Trump might want more aggressive cuts and you might want to drive things lower. But if this isn't shifting, if this watch tool is not shifting, or if the yields itself are not shifting, I would be a little bit on the cautious side that the Fed is not going to do anything other than hold and make sure that data comes in as expected, be a little bit restrictive. But let's take a look at the actual numbers. Here's a Bloomberg economic calendar this morning, and here we go. 8:30 a.m. news. Here's a nice little chunk on CPI data. So we did have a decent news yesterday on producer price index. But for today, I thought it was interesting that we had a previous print on CPI at 3.3, came in forecast 3.3 going into today, and it came in 3.2. So that actually was a lower than previous and lower than expected. Okay, good. That's core CPI year over year. We had a previous print for the month over month. This is core CPI. Previous print was 0.3, forecasted 0.3, came in 0.2. That was slightly better as well. It still shows there's inflation. It still shows things are higher. It's just, okay, so it's less than expected, less than forecast. The core CPI index, previous print was 322.66. It was forecasted at 323.40, came in 323.38. Barely a beat, but I'm going to say this. It was a lower than forecast, but higher than previous. All right, so we'll say that that's a mix. It's a bit of a wash. CPI year over year, previous print was 2.7, forecasted 2.9, came in 2.9. That is higher than previous, and it is equal to or I should put it this way: it's equal to forecast. Equal to forecast and higher than previous. That's probably not a good thing. 0.3 previous, forecasted 0.4, came in 0.4. So that is higher than previous and equal to forecast. 315.49, 315.61. So that is higher than previous and 1/100th less. 1/100th less. And then CPI index, there was no forecast there, month over month. So I look at it this way. I don't see this as like it's all awesome news. You know, I mean, I think the market headline wise is all excited about this right here, but it's still higher. Are we anywhere close to 2% right now? Are we anywhere close to 2%? Not even close. Okay. Now, to take this one step further, let's go to this third party inflation reading. This goes back to last year. Okay. This was a lot of progress on inflation. This is not progress on inflation. This is now chop inflation. We are still sticky and elevated around that 3% handle. Now, if the Fed in reality, and they'll never say it, they will never ever say it, okay? But the Fed is realistically accepting this 2.5 to 3% inflation window. That's what they're willing to say. They're not willing to say it. They're willing to accept it, because clearly, when we got down to low twos, they're starting to cut rates, and all of a sudden we started to see a bottom in inflation. Inflation goes higher. Here we are back up towards 3+%. So if the Fed is now restrictive, they're hoping, I'm pretty sure they're hoping, that inflation will start to trend lower again. And so maybe this is what inflation looks like. And this would be a good situation if we have, inflation and it goes lower. That's probably a sigh of relief from the Fed. The concern is that this is just a matter of time before things get more expensive. And nobody knows what it's going to look like when we start putting in tariffs. Nobody knows the full information about who's going to pay what. Is it the U.S.? Is it U.S. importers? Is it U.S. exporters? Is it U.S. related? Is it U.S. trading partners? Is it the big enemies we have? Are we putting tariffs on China and Russia and sanctions? I don't know. But if there's any added friction in the global economy, it's going to be more expensive. And this is a big question mark of where we go. Higher inflation is going to put a lot of strain on growth and a lot of strain on the consumer and a lot of strain on the global economy. So anyway, I think it's a great little pop for the day, but am I a little cautious? Sure, of course. Would it make sense that we could, have this be all exciting and then fade? Yep, it can be. So I did put on a trade this morning. I'll update this in my Pulver alerts. I put on a 590 by 570 bear put spread, and it's a trade that cost me $5. So it cost me $5 for the potential to pay out $20. That's good. So I'm paying $5 to make 20. So my net profit would be, if I pay 5 to go after 20, okay, my net profit could be $15, which is a pretty good return on capital. Okay. Now, realistically, if I take the $5 and turn it into, let's say, $1,000 profit, where I can close this thing out for like a $15 winner or a $10, even a $10 winner, I'd be happy with. So I'll update that. I did the 590 on the SPY by 570, and I could have gone down to 565. It would have cost me an extra 70 cents, which, if you think about that costs very little to make another $5 of profit. But I just thought it's cheap enough, $5. It's like 0.16% risk on the trade. If price goes higher, then I'm going to sacrifice that $500 trade. If price is doing what I think we might be looking at here, and everyone is all excited, and I hate to rain on your parade here, but I wouldn't be surprised if this market has a little bit of drift here and then starts to fade off of some technical resistance. Like, I don't think the problems are solved. I don't think that technically we pulled back enough. I'm less bullish. If this market gets to all-time highs, I'm less bullish. Okay, if this market is going to still respond to this channel, if this market responds to this channel, and even if it's this way and it's this way, and it's going to be this slow, agonizing, like, we're only down like 8%, but it feels like it's an eternity to get any type of meaningful correction, you should still be thankful that it's not like this nasty, like, fall off a cliff feeling, because that's way more difficult to trade. It's nice if you have cash to deploy at the bottoms, but it is way more difficult to get liquidity. The markets are crazy. It's good to sell premium, but man, it's a wild move, right? So point is, if we're dealing with a correctional phase, okay, there's a lot of resistance ahead. The market could reject right there. The market could have a fake out and reject right there. The market could come back to the holiday highs here and fade again. So I just wouldn't get all excited to think all-time highs are around the corner, because they probably aren't. All right? Does that mean I'm a bear? No. It just means that I think this market is going to struggle to get a lot of momentum to the upside. This inflation data today, even the inflation data yesterday, and even PC at the end of the month, the Fed's not doing anything, right? If it was all solved, then the Fed's like, oh, we're going to cut rates. Inflation looks great. It doesn't. Inflation has ripped pretty high the last 3 months. Okay. Is it reasonable to think that it'll take 2 years? I mean, I don't know. Is anybody trading 2 years from now? If you've got a long-term horizon, the market right now is not, they don't care about 2 years. Okay. The market is like, what's happening over the next 30 to 60 days? What's happening this quarter? Sure. If the Fed is lucky, we'll have inflation down into the low twos, but honestly, we probably won't. I think the new normal is we're probably going to operate between 2 and 2.5% if the Fed's lucky. To get inflation back down to the low twos or sub 2, we probably have to have a recession. We probably have to have a reality check. Just because it's like the cleansing and the purging that the market needs, the economy needs to then kind of rebuild, a solid foundation and then grow from it again. But we're sitting at like these bubbly levels where I don't know how we can just keep operating thinking that things are going to get better. Boom, just got some profit. That was good. That was a little SPX trade on some profit. Nice. Okay, let's see what else. That's SPX. So any questions on that right now? See, it's a pretty clean channel, so I just wouldn't get overly excited about today's news. And look at the futures market. So if the S&P futures market comes back into this area, then I could see the big news candle forming a bit of a top and maybe gets faded. So I don't know, just buckle up. I think the market's all excited, but just be careful.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.